So, yesterday you were involved in that wild, wild west TLRY scenario, and you laid out some trades. I can't remember if you actually got involved in any of it. You did, actually, didn't you?
Yeah, there was one early where I ended up getting well in the money and then came back the other way on me, and I tried to get in later, and I couldn't get a locate on any shares around the 255 to 260 area, which was awfully frustrating considering it was at 150 about 15 minutes later. But yeah, I don't have any now. So
Yeah, well, Brett, did you ever have a teacher and when you were growing up in grade school or whatever, and maybe somebody in the class was eating some candy or whatever, and the teacher would say something like, if you don't have enough for everybody, you can't have
right.
any at all. So with your little strings that you're pulling over there at Morgan Stanley, calling up your contacts, how come you're not letting us in on any of this?
Oh no, this is very rare. It's in exceptional circumstances where they're very exotic trading instrument or a short where I can't get anything online.
I know. I'm just giving you a hard
Yeah,
time.
right.
Because
Sure.
us, you fancy people over there that live on the right side of the tracks, you get to, get all those fringe benefits. With fancy brokers and all, us who got to use TradeStation and interactive brokers, we get rejected.
There's nothing wrong with TradeStation and interactive brokers, Jim.
I'm just messing with you. All right, so we didn't exactly get the trading action that you were hoping for today. We didn't get that test of the highs, or I guess why don't
I just wanted 260 again. Just something where it really scares you into thinking it's going to do it again. And I wonder a little bit if yesterday's action was bad. Enough for some of the brokers that were going to allow people to short if they could find shares. I know Interactive Brokers designated it as unshortable, and not, I think, because they couldn't find shares. I think it's very much like the brokerage did not want to take the risk at that point because they'd been left with too many negative account balances from people who did get shares short at 100 and kept them until they got wiped out when it went to 250. And brokerages in that situation will usually get pretty risk averse, and they can institute policy decisions that say, we're not going to allow that type of thing to happen again. And I wonder if people who were short coming in today, that it's possible, this is such a unique situation, but it's not impossible that today we had some impossibility of squeezing simply because some larger shorts were worried that they wouldn't be able to get back in their short if they covered. And so they just basically made their bed with it and said, you know, I'm not covering, it doesn't matter what happens, making it more difficult to get that secondary rally. It's not impossible. I mean, basically, if you put a gate up, you know, to reshorting it, you may prevent some decisions of covering.
I'm curious. I don't know who has access to this, but there's got to be a lockup from this IPO coming up pretty soon. Do you know when that is?
6 months. It's a 6-month lockup. Damon and I were talking about this yesterday.
Okay.
And that is, I think this is one of the things that just defines this situation. You've got a small float, and you've got a really highly marketed situation, and you've got a lockup that keeps a lot of people from selling. Just there's enormous supply that can't come on the market. And you also have the strange situation where this received a lot of attention as the first cannabis IPO, and there's a lot of people who have their money in accounts where they can't really use that money toward OTC stocks, and all of the big cannabis companies in the planet are on the OTC because they're Canadian companies, and they don't trade in the U.S., except for Canopy, which is a Canadian company that's also on the U.S. exchanges. Otherwise, you're looking at Canopy, Aurora, Aphria, Organigram, a few others, SPRWF, that are they're sort of the real cannabis producers. They've got the big capacity, they've got huge cash balances, they're expanding dramatically. And then there's Tilray, completely separate story, not remotely in the league with those guys, but it trades easy to get to for U.S. investors as a cannabis company, and I think it's come to symbolize for people exposure to cannabis for retail traders. And so you've got a situation where there's a lockup, there's a lot of shares that can't be sold, there's a small float anyways, and it's the only thing that people know about in the U.S. as a U.S. retail trader. It's synonymous with the concept of gaining exposure to cannabis. And it's just led to this crazy bubble. And it's cartoonishly absurd. And, you know, I think that as we approach the end of that lockup, which should be in, December, you know, this thing is going to be discounting, coming back down to probably about $1 billion market cap where it should be, which is about $15 a share. And, you know, we'll see where it ends up, but I think that this is just lunacy, what we've seen at this point. Because, again, this is, at one point yesterday, and I posted this on the trade, on the page, at one point yesterday, Tilray had a market cap of, I think, $22 billion. And if you take out Canopy, you just look at the next 5 biggest cannabis companies, which are all much bigger than Tilray. Much bigger in terms of their actual production, operations, everything. Much bigger. It's like Tilray is like an oil company with a couple rigs that's suddenly pricing at a market cap that's Chevron and Exxon combined. Like, think of it that way. And Tilray was at a market cap that was those next 5 big cannabis producers combined. And those are considered to be in bubbles. So just imagine how distorted the situation is with Tilray, which is uniquely distorted. This isn't a pot stock bubble, it's a Tilray bubble. It's a very separate and individual stock phenomenon that's not indicative of most of the stocks in that space, which also may be way overvalued, but they're just, this thing is in the stratosphere by comparison. So, and I think it's a product of having this unique situation. It's really synonymous with the U.S. retail investor of the only thing you can buy to buy into cannabis exposure that people know about. And having the lockup in place so that a lot of the, I mean, you can imagine the experience of being somebody who's got like founding shares in this, and they're a billionaire on paper right now, and they probably have an idea underneath the hood of what this company's really worth, and by the time they're going to be able to sell after the lockup, that's just going to be gone, and there's nothing they can do about it. and it's just a strange life for those guys right now.
I was just trying to imagine that, being that
that'd
guy.
Be a nightmare, right? Like, just you're looking at, oh my God, if I could just sell here. But that exact idea, that exact feeling is why the market's going to discount into that lockup expiration, I would imagine. Because it would just be like, even if it's at 50 then, the rush for the exits, I think, from those same shareholders would be, I mean, you never know. Obviously, sentiment changes things. People may have different views on the situation at that point. But right now, it's got to be just torture seeing, if you've got huge founding share allocation in that company and it IPOs and you couldn't exit, or you bought into that IPO and you're locked up for some scenario, and you're watching this go from 20 to 300, and really as a phenomenon of a mechanical issue rather than some kind of, I think, market discounting growth. It's just got to be somewhat torturous.
All right, so I'm going to put you on the spot. How does this compare to the most famous bubble that I'll call the tulip bubble?
The tulip bubble, I wasn't trading during the tulip bubble.
Oh, so come on, Mr. Interdimensional previous life. I'm sure you were out there.
I didn't have the time machine then, so, which doesn't make any sense as a statement. But I have no idea the answer to that question.
I figured
that was obviously.
I figured of all people, you would have went back in time to try to graph a chart and put it in perspective.
I actually shorted the top in the tulip bubble.
Of course you did.
Yeah,
of course you did.
I've been rolled into contracts.
Yeah. All right. Well, we'll see how that one. We'll see how that one works out.
I did compare it yesterday to a couple just recent memory feelings, like being involved in silver in 2011, the Nikkei in, I think, May of 2013, the DWTI short, or picking the bottom in crude oil in February, or actually late January of 2016, and then Bitcoin in December, just in terms of some of the dynamics of something moving outside of some sense of its moorings in a psychological process, and then having people who supply the possibility of counter trading it start to tighten up their willingness to let people do that. Like silver, for instance, there was a big shift in margin requirements because people were getting blown out trying to fade it. And it's kind of similar to what Interactive Brokers did yesterday with allowing people, just even if you can find shares, we're not letting you short this because we're afraid you're going to blow yourself up. That kind of process. When something gets that far unhinged and people can see it, and the process somehow rolls on enough to hurt them bad enough, and then you see some kind of regulatory hurdle to taking action in that direction again, which seems to support it going further. That whole psychological phenomenon is similar, I think, to those four other situations. This situation and those four other situations were relatively similar, and that's where I kind of got that pattern from that I talked about yesterday, that in my experience what you'll see is a pullback and then a move that gets really close to kind of tipping that next extension, because at this point it's a parabolic move. And when you think about the concept of a next extension in a parabolic move, you can look back at the Tilray chart right now. If you take it off of logarithmic scale, if you really look at the exponential curve on that chart, which is what it is, that parabolic kind of feeling, each time the chart scale changes, because you can move back, if you slide it back to a couple days before, so you're just looking at a Monday's move or something, where it's up headed toward, actually Tuesdays I guess that was, where it's headed toward 150. That looks like the most dramatic extension you can imagine. And then you scale it one day further and include yesterday's, and then it's more parabolic. So if you start to get the idea that this thing is headed up through 300, well then the next day could be 650. The parabola keeps on redefining itself, and it all looks the same on a chart. It's just the scale on the right-hand side changes dramatically and geometrically. So you are, subject to this fear, if you're short this, as it starts to creep back toward that next extension, that you're going to be wiped out. And I think that process, the topping process is really a matter of starting to trigger that level of feeling. And if you get to the point where you get to that sort of preface to that next move like that, and something stops it. It stops short of that and starts to roll back over, then everybody who's shifted around out of fear or greed related to that expectation then shifts back. So everybody who is covering in front of that, thinking, oh my God, I'm going to get wiped out if I don't cover now, they're getting out of their positions. And everybody who's thinking, oh man, I'm going to get rich on this next blow-off squeeze, is getting into those positions. And as it rolls over, everybody has to rebalance it back out the other way, and that's what really triggers and fuels that acceleration back to the downside. So you have to set that up by triggering that fear or greed around the idea of the next exponential extension of that parabola. And I think that that makes that trade easier to get this short if you see it get to that kind of point again. And I don't know if this morning's move really accounts for that, but it's tough. And again, there's some unique dynamics here because of what I said earlier, where you may have a situation where there's some people who are so convinced this is going to 15 by December that they're going to find a way to finance continuing to hold the short if it goes to 1,000. They don't care because now they're worried about being able to get back in. They're worried about somebody, whoever they're working with as a prime broker or an online broker or whatever, not allowing them to put the trade back on if they get out. And I think that might be kind of warping that pattern a little bit, but who knows? That's the dynamic I was looking for.
All right. So, are you gonna? So what you wanted to happen today, the way you laid it out, didn't actually occur. Are you still waiting on that to happen? Is this something that can happen Monday?
Yeah, absolutely.
Okay, so
in 2 of the 4 cases, it was something where it was 3 to 4 days later that we got that that next moment of trying to inspire that repositioning around the fear or greed of the next parabolic extension. So that would be potentially in play Monday. I mean, we are starting to really leak out in this thing, and it did get to a point that was, I mean, on any rational basis, again, it was absolute lunacy even as of when it was at 100. So seeing it at 300 yesterday, it's possible it got so far out of whack that it can never get back close to that. I just don't know. When you're trying to look at the relationship between psychology and expected market pricing, I mean, anything is fair game. We saw that in the dot-com bubble. Companies that had no business whatsoever were IPOing and moving up more than this with no business, just an office with one guy. That was not uncommon. So it's possible, and this has that unique kind of element involved, which really I'm not sure which way it pushes the situation of being, it's so there's such a craze around these stocks, and there's so few places to go with U.S. retail capital, particularly if it's in an account structure that can't buy foreign equities and can't buy OTC stocks, then you pretty much got Canopy and Tilray, and it seems like people don't understand Canopy as an option, which seems to me like a much stronger option.
All right, so let's assume that this stock is still going to be hard to borrow. I would think that the most logical way to get involved on the short side, and let's say you can get a borrow from Morgan Stanley or whatever, and normal folk can't do that. So would a viable strategy be to get ready to have your option box open and short some calls, out of the money calls that are priced pretty crazy. Let's just say, I don't know, 350 calls. Would that be a viable strategy? Is that how you would encourage somebody as an alternative strategy?
I think it very well could be, and especially if we do get, let's say we do in the next few days, we do get that kind of move back above 250, and we start to inspire this kind of situation. What you should see is a change in option pricing that reflects that expectation of a greater potential of that next parabolic leg. And that would be exactly when you want to take exactly the trade that you're talking about. Mm-hmm. So you should see, for instance, much more attractive pricing on exactly the strategy you're talking about. right? And that would be particularly advantageous at that point. So yes, if we see a move back above 250 and you start to see put prices drop and call prices soar, especially for wildly out of the money stuff, then that is absolutely perfect strategy, probably better than naked shorting to sell those calls way out of the money.
Yeah.
But you'd need to see that shift in pricing.
Well, you have to be ready, and that's why I'm giving the listeners alert for that. Because
it's a good question.
And when you're looking at something like this, I'm glad you mentioned that, hey, this could happen 3-4 days from now, so that at least people can be on guard for such an event. And you don't have to worry about going out and getting a borrow. I guess the only thing, whatever your margin requirements are for a particular option, I know sometimes they could be pretty high if you're selling options. I don't know. They're different for each individual brokerage. But I would, if you do something in advance, I would try to make sure that you're capable for that, because the last thing you want to do is be all set and ready to go and push the button and you get a rejection and, hey, what happened? And before you know it, it's too late, because you know how quick this happens. Just yesterday it was halted.
Yeah, you're exactly right. And I'd suggest people think of it like a trap set. We can set a trap, and we don't know if the market's going to walk into it. But what it looks like if the market walks into it is the price of Tilray equity moves up above 250 again, and you start to see that contortion in options. So understanding where the options are in front of that move and understanding how the options change, and if you start to see, just the evidence of decreasing demand for out-of-the-money puts and a clear increase in demand for out-of-the-money calls, then I think that you're seeing the market walk into that trap. And I think that that's something where, if you take a size and you understand your risk, it's a no-brainer to at least take a shot at that trade.
All right, so there's your preview. There's how you can trade it if you can't get shares. I know we get a lot of questions on it. Hey, where are you getting these shares from? Or I can't get a locate, whatever.
I would also say to people, it's a good thing, a little forethought. Establish a relationship with a desk like that. You can do it. You don't have to be a millionaire. It helps to have a larger account to be able to establish that relationship, but you can network into these things. Get in touch with people. Get to know people. At a Morgan Stanley. Get to know people. Perhaps there's somebody in your family who has a contact. Perhaps there's a friend of yours who has a contact. These are human beings. If you can get a relationship there, and you can send a bottle of wine around the holidays, and, people will give you access to things. There's a culture there.
You hear that, listeners? Just tell them you know Brett Manning. There you go. All right. So let's move on to more of your wheelhouse, because this is somewhat of an exception for you, and I haven't talked to you in a couple of weeks. So I know you're working on your chart book, and I guess this is a good place to preview into that. It'll probably be ready, Monday or so next week?
I'm thinking Monday, yeah.
Okay, so why don't we get a preview ahead of time of what some of the things you're looking at, some of the markets that you're focused on, and what opportunities may be in store?
Yeah, so one of the main themes that I'm looking at is the trade war. I know it's a thing that everybody seems to be looking at on some level, and just understanding the game theory around the steps that we've seen and how to conceptualize it, and some of what we're seeing from market reactions to things, which I think is one of the most important and interesting phenomena that we've seen in the last week since I've been back from vacation. I think the most interesting thing that we've seen is the implementation of the new raft of tariffs, or at least the announcement of the new raft of tariffs, and then the subsequent rally in Chinese stocks and the rally in stocks everywhere, and the steepening of the yield curve and the decline in the yen, all of the things that you would see as being an across-the-board risk-on response. That's what we saw clearly triggered by the announcement of the new round of tariffs. It wasn't a coincidence. It's very clear. Now, I don't think the cause is the announcement of the tariffs. I think the cause is the fact that Chinese equities rallied in response to the tariffs, I think, is what was the first domino. And I think what we had was a prepotency of a situation where people were hedged, people were waiting for this, people were, holding yen long, holding bonds long, holding equity shorts, holding, exposure to some kind of hedges in China, all sorts of things, waiting for this announcement, or at least out of the opposite of those positions if they wanted to be in those positions. So, dry powder on the sidelines when they want to be long equities, things like that. And once the news came out and you see no crash in China, just all of those positions then started to flood back the other way, and I would say probably because the market's genius is understanding that this is the last such announcement, at least for several months, and we're going to be probably through year end, and possibly ever, and that's the other point. I don't know if you were going to insert something in there, but I can keep going if you want.
No, I was going to let you keep going until you talked about what you thought the Chinese market was going to do. I have the A shares up as a proxy for that, and what I notice on this chart is it's not like we got a huge pop. We haven't even tested what I have drawn. It's just a simple trend line on the A shares. It's a very choppy looking chart. However, it doesn't look good. It doesn't look good.
Yeah, but I mean the reaction move. Let's say you're right, there's the larger trend. But if you look at the market reacting to the announcement just as a simplistic sort of face value phenomenon, you can see the turn and rally rather than the dive. And you have a wedge there. You're seeing a wedge if you look at that chart, right? And it looks like your chart is above the top line of that wedge. Now, when I just look at it's just leaking above the top line of that wedge, just the wedge itself, right? If you just hit the tops from the last from August and September and late July, I guess. You have a move up to the upside of the wedge. Now, wedges can be reversal patterns. It's not an uncommon reversal pattern. Wedge tops, wedge bottoms. But the fact that it's coming on news that should be sending it the other way in a very face value interpretation is big. I mean, that's how big market inflections happen. You get news that should push a trend in the same direction as it's been going, and it's a trend that's been showing declining momentum on a swing-for-swing basis, and then it moves the other way relative to that catalyst. This is a pretty clear technical recipe for a major inflection in a market. Now, I don't know if that's what's happening here. So I want to just to reframe the game theory of the situation. I have a relatively unique hypothesis, I think, about what's possible. Just looking at everything. So the way that I'm thinking about the whole situation first is I've noticed in analysis that there's been two basic perspectives that have emerged. You can kind of group people into one or the other in terms of how they're looking at the situation, and this is not meant as some kind of real statement about it. Just my fun names for these two ideas are dumb China and smart China. Like, those are the two kind of perspectives. And dumb China is the perspective basically that if you think China's done a lot of research on how to handle U.S.-China relationships, and they have accumulated research over 2 decades, and they've had people in Washington, D.C. actively trying to understand next moves from the United States. And so the dumb China perspective basically says, well, because when Trump came in, it was basically just a complete turnover in Washington, D.C., and Trump himself can just walk into an office by himself and just decide what's going to happen, and he didn't know 5 minutes earlier what's going to happen, then he comes out and tells people, and that's what happens. There's no way to predict that kind of thing. And so it's the idea that China's been basically one step behind this whole time, and they're just trying to catch up. And, the sort of comic vision, the visual that I have of this is like a Three Stooges episode where, Xi is Mo. And they're trying to figure out how to respond to what Trump's doing. That's kind of the dumb China perspective, is that they've been caught off guard by the unpredictability, the whimsicality, the impulsivity of the Trump White House. And, they're playing catch-up. And so if you interpret everything through that lens, you come up with a very different idea about what's going on than the other lens. And the other lens is smart China. And the smart China perspective, and again, I'm just categorizing things that I've read from other people. There's kind of, everything seems to be categorized in one of these two basic perspectives. And the smart China view is that China is basically a poker-faced chess-playing master that's been spinning a web ever since Trump won the presidency, masterfully engineering some remarkable victory against what would seem like insuperable economic odds given the trade relationship. And, and they've been one step ahead of the White House, just baiting them along and figuring out exactly how to play a situation. And the first step of that was, in response to Trump winning the White House, they named Xi Jinping leader for life and took away any kind of political risk there so that he could make long-term decisions. And then they started early this year baiting the White House into a policy situation where they would try to get policy situation in place that into the midterm elections would be offending the GOP's biggest political donors. And if you think of the Koch brothers, this is exactly what's happened. Because this policy agenda by the White House has been hurting business owners. It's a tax on imports. It doesn't really change anything for the positive unless or until China concedes. And all of this is going to be at full volume, just blaring right into when people go to the polls at the midterms. And that precipitates a Democratic takeover of the House. And that leads to an impeachment of Trump and a kind of historic level rebuke of protectionist trade policy in the U.S. Like, that would be the smart China view, is that they've just orchestrated this perfectly and magnificently. And it's all just led to this. The only way that they could defeat a protectionist regime coming into the U.S. In Washington, D.C., is by kind of playing the puppet strings just exactly this way, and that they've managed to do that. And so I don't think either one of those perspectives is really on the money, but I think that there's kind of a little bit of both going on. And I think what happened was, I don't think that Xi Jinping was named leader for life really necessarily because they realized this situation would be happening, but I think it's sort of it's lucky for them that it worked that way. It's just serendipitous. And at this point, they've ended up with a situation where now they've had a hand of cards handed to them, dealt to them, as of maybe July or so, where maybe they started to realize that they could further bait the White House. And I think that this latest round, I think that's essentially what happened. I think that Beijing has been playing this coy game where they're ready to talk, and that's kind of a sign of weakness in negotiation, especially to somebody like Trump, getting ready to concede. And then when they do go into those talks, they don't give any ground, but it's sort of teasing the White House into thinking that, they're close to cracking. And so it's time to hit them with the next big threat. And all of this is really, I would imagine, sapping political motivation among GOP voters in front of the midterms. I think that that's probably something that is hurting the situation for the White House longer term. And I think that Beijing has started to play that strategy, I think, overtly at this point. And I would say, at the risk of being too political in this, that the best move for Trump, if he were to want to reverse this, is just to kind of look for some very minor concession from China at this point. Just pull the tariffs completely, label the trade war fake news, and start changing the topic to lowering taxes or something. And to do that like next week. I think that would probably be the best strategy from the White House, because if they lose the House of Representatives, it's going to be just a very different presidency. And a lot of the things that were on their agenda just will have no chance instantly. And who knows what's going to happen as far as the Mueller investigation and everything else. So it looks to me like there's one other theory about what markets are doing right now, is starting to take a look at the China response was so completely not conceding in response to this, just lodging a threat or lodging a complaint with the World Trade Organization and starting to line up stimulus policies, which basically is like, hunkering down, we can do 10 more rounds of this. And the question is, are markets starting to take a look at the possibility that there's at least some percentage chance of the scenario I just outlined, of basically the White House just trying to back out? Like they realize they've just decided to, precipitate a land war in Russia, and they're going to retreat because it's not working, and they could lose control of the House on that basis, and that the situation could possibly be rescued if they backtrack full scale. So that, if you can imagine what would happen, just think about market action if suddenly that's what happened. If the White House just said, the trade war with China is over as of this moment, and we're going to focus on lowering taxes. Like the S&P would probably gap up about 5%. And what we're seeing is market movement in the direction of that kind of thing. And we're seeing, I would say, a political scenario that suggests probably not large chances of that kind of shift. But with this president, who has such a history of being able to change direction abruptly on anything, really, more than any politician I've ever seen, he can just simply change everything about a situation at a moment's notice, just whimsically. And he has carved out the latitude to do that. People expect it of him. It's not impossible that we could see that. It's not impossible that markets are at least having to account for some possibility of that, because the way that things are going, the direction that things are going, this is certainly not going to help his chances of maintaining the House.
All right. So with all that said, how does that relate to the markets, and how do you capitalize on it?
Well, so, I mean, what it said, it's just another way of looking at what we've seen, which is a wholesale risk-on response. And, you know, that includes China, but it includes everything else. I mean, look at the yen is just diving. The Nikkei is breaking out as a consequence. The yield curve is steepening. The dollar is, relatively speaking, weakening. Everything is moving in the direction that you'd want it to be moving if you are exposed to risk assets across the board. And that, you know, if that's going to be the characterization of a situation where we don't think that there's going to be any new serious threats. And again, I said from that scenario that I just outlined, either because of the House winning or the Dems winning the House or because of a backtracking from the White House about the situation, either way could mean that while everybody's prepared for 2 decades of a trade war with China, you know, it's possible that it's heading toward ending. And everything seems to be pushing in a direction that says, you know, we're moving past this, even though we haven't seen anything official or legitimate suggesting that, or even hints of that. That's how things are acting. So I suppose it means, you know, we're not going to see the correction that I was looking for in the NASDAQ to break under that 50-day moving average and at least spill some things out, which is, you know, kind of like a feeling of humidity rising but no rain happening, which is much nicer to start to load up long after a nice rain. But it's just, it's not happening. And, you know, sentiment data, where it is right now, as I kind of brush through that stuff for the chart book, is still really neutral. I mean, as I define it, as I understand it, looking at positioning and looking at you know, surveys that blatantly ask people how they're positioned, and then also looking at instruments related to options markets and everything else, it's you know, it's still, there's a little bit of lean toward bullish positioning and things like the robo ratio, but you know, it's nothing to be concerned about. So sentiment is not an issue, and the market is trending higher. And certainly, I would say, if you do see some kind of shift in how the trade war concept is being focused on, it's going to have to be something else that's politically attractive to draw more enthusiasm from GOP voters. Then that combination could be just, you know, really ignite a blow-off move in this market next month. So that would be, if we can't get the correction here, just into the end of the month, we can't shake out things a little bit. We can't, you know, get some of these moves like Netflix down to tap 300 and that 200-day moving average, Google slipping down to get that 200-day moving average, you know, maybe getting a little bit of an underside chuck through on Amazon at the 50-day. Just see some of these basic run-of-the-mill expectations for a correction when you've got a group of stocks like the FANG stocks that seem to have entered at least a lagging period relative to the rest of the market. You'd think you'd get some of these little shakeouts of people who were over-levered in those long-side moves. And we're not getting it. And the market's holding on just fine. It's not busting through any levels. It's not shaking anybody out. And it's just kind of, you know, turning unceremoniously and grinding back higher. And I really think it just kind of keeps you from getting aggressive. If you're going to short, if you're going to hedge, just, you know, do it the way that I've been doing it, where you're basically taking very little risk with outsized targets that are very well defined. So if you've got some long exposure and you've got some short theses, you know, you're at least not, don't scale into shorts in a market like this, I guess, is the main thing. There may be some opportunities to take some opportunistic shots, but, you know, take what the market is giving you and have predefined targets and have tight risk.
Well, so at what point do you look to get involved on the long side in the equity markets? Are you looking for those type of scenarios, pullbacks or breakouts? What's the plan?
If I put the trading book in long the market, it's going to be on some kind of pullback.
Okay.
I want to see, yeah, I mean, if we've got a situation where we've got a VIX at 11 and we've got sentiment data neutral to slightly bullish, you know, I'm not going to be doing a lot of top-down long side with the trading book. But if we get, you know, if we precipitate some rain, we get some people caught off guard, caught leaning the other way, then this is still a context that should lead to a melt-up at some point, and there, yeah, that would be the approach.
All right. So We've already got a breakout in, well, we're at new highs in the S&P pretty much as we speak. We saw a breakout in the Nikkei. Which markets are you going to target?
The Nikkei is a good one. The pair trade that I talked about the other day is a possibility where you get short the NASDAQ and long the Nikkei in pair, which basically allows you to be positioned for that hedge breakdown, but also be long the market. I think this is just basically the idea of some rebalancing because we've seen such U.S. dominance for most of this year around markets, and really if we're starting to see that risk on response where we see people giving up the yen, then that puts the Nikkei back in charge, and it's been breaking out. So the Nikkei is definitely a piece of that puzzle.
All right, let's move away from equity markets then, and we can talk about your gold position. This one's been resilient. I've been keeping an eye on it pretty much every day, and it'll see a blip, a short sell-off, and every time it pretty much responds favorably. It doesn't move a lot in big chunks, but it does, have its little drawdowns here, but it gets
But it's been holding above 1200. It's been holding above 1200 basically. The one thing that I don't like about it is that it started to lag the euro a lot.
Okay.
And that, has been a key indicator for gold. It's been so well correlated with the euro for the last year or so that seeing it lag the euro is like seeing it miss an opportunity to rally more. But the euro has been strong relative to other components of the dollar index. So it's really not doing too bad versus an inverse idea of the dollar. But it would be nice to see it at least tracking with the euro, because what's going to happen when the euro pulls back if gold's not rallying much when the euro's taking off? It's a little bit of a concern there. But at the same time, just like you said, sentiment is horrible on gold, and it's been resilient. And particularly resilient in the midst of the latest move higher in long-end interest rates, which as far as I can see is not being accompanied by a serious escalation in inflation expectations, which basically means you're seeing a rise of real rates. And a rise in real rates is usually the worst possible thing that can happen for gold. Interest rates go up without inflation expectations going up. It's just a competitive dilemma, and gold usually gets killed during periods like that. And it's probably one of the main reasons we've seen sentiment move where it has on gold, is just simply looking at a picture where you're seeing rising real rates. And the fact that they've risen a lot more in the last few days and we have not seen gold sell off is definitely something that is just as positive as the lagging euro correlation is negative. So it's balanced, but it's probably something that I'm going to want to add to because it is acting resilient. And we know where sentiment is, we know where positioning is. There's not a lot of new shorting of gold that's likely to come in. There's not a lot of longs in there at all to sell. So it's hard to see where selling pressure would come from, which makes it relatively safe to maybe move the stop up a bit, maybe add a little bit of size to it and look for that breakout to 1250.
Okay. It's trading not too far away from where you got in. 1206, I think, was your price,
Yeah.
No? Yeah,
Yes.
All right. And then where would you likely put your stop on this one?
1180.
1180. Okay, so moving up the stop from what were you were down like at 1160, so moving up about $20 or so.
1166. Yeah, 1166 to 1180.
Okay, so even those who haven't gotten involved in that one, maybe they a little late to the party, you're really not too far away, and you can actually readjust and get in on the same thing at a lesser risk now. So
I would say this is, the risk has been cleaned. We have puked under 1180. That's what had to happen, right? I mean, we did that work. If it goes back under 1180, you don't want it. It did that. Like it took that out. It ran all those stops. It plunged through, and then it came back up like a beach ball popping out of the swimming pool. And now it's sitting there on top of the surface, and it's probably not going to get dunked down under again. So I think, if I wasn't in this, I would be buying it now with an 1180 stop. And so the question is, do I add to my current position? So if you're not in it and you understand the argument that I've made on gold, then I would buy it now and put an 1180 stop in.
Okay, and if anyone is looking at the visual or wants to go back and listen to this one again, here's that sell-off that he had down there, down to the 1166-ish area, and we've had a consolidation back through that level, and you can see where it's consolidating, and a breakout you would suspect that this would traject higher. So maybe that 1250, even 1300 doesn't even seem like that far.
I'll tell you what, if it gets there, then If it gets there, then it's going to be 1400. That's the question. I mean, if you move back up, I think at that level, at this positioning in this long-term kind of situation, if you get 1300, you're getting 1400. So that's the whole basis for this idea and wanting to stick with this and having such a wide stop was simply that, there's multi-level framing for setups, and you have something on on an hourly chart that has its own setup, and it fits into the fold of a daily chart that has its own setup, and that fits into the fold of a monthly chart. And in this case, I would say you've got that essentially like a wave 4 of an ascending triangle pattern where the trigger level is around 1350. That you can see if you look at a very, very, I don't know if you can trigger a weekly chart on that and scrunch it up so you can see back 5-6 years. You'll see on yours. But this kind of fits into the context of when you've got sentiment that's worse than it was at the lowest lows, and you're at a higher low, and you're in the context of what would be a very bullish pattern if it moves higher out of this level, then you get people off balance here. It suggests, a greater ability to move back at least enough to start to form the context of that larger pattern. Then, it sets up for that next, triggering sort of that next level of that setup. Oh, you don't have a continuous contract?
No, I would have to change it. Yeah, I'm sorry about that.
Right.
I can
you could do GLD.
Yeah, I was just going to do that. GLD, and we'll look at a weekly or a monthly?
Why don't you put a monthly up?
Okay. So we're going back to 2011.
Yeah.
Or so.
And you can see where this leg fits into that larger pattern is basically a higher low, but with the worst sentiment that we've seen in a very objective manner. And you can see kind of the outline there. Since the lows in late 2015, you've got kind of an ascending triangle. If you can see on a very, since 2015. So you can see that this would be sort of like the fourth leg with the fifth leg up, back headed to that 130 area, where 130 would be the trigger of a bullish ascending triangle breakout to 1400 in gold. That's the idea, is that you're catching the bottom of a fourth leg of a monthly chart ascending triangle, which is why I'm so interested in it and willing to add as it starts to work rather than, scalping profits at 1250.
Right. All right. So I think that covers a lot of your current positions. I haven't gotten your take on crude oil in a while, so why don't you help us break that down a little bit, because we do have, I guess, a minor OPEC meeting on the horizon.
Yeah, and I haven't gotten to my crude oil research at this point in the chart book, but I can tell you that it's the least interesting that it's been to me in a long time, and that fits with the view that I put out in my last chart book, and nothing's really changed. I said last time around, I've been kind of looking at an upward trending market since basically middle of 2017 as my going thesis and the way that I frame that market. And as of a couple months ago, my view changed to, we're in a politically defined trading range that has boundaries based on the relationship between the White House and Saudi Arabia. And it's very policy-based, and it works because the market's not imbalanced in one direction or the other in any way that's important, which means it's going to be defined by factors like that. And there's nothing wrong with that. You're going to go through periods like that in crude oil, and I would say we are in a trading range that is going to persist for possibly quite some time, and is probably going to be roughly at, where the White House is angry. When it's on the downside where the shale oil players can't make any money, and on the upside where it starts to become a tax on U.S. consumers, and OPEC wanting to be, particularly the Saudis, wanting to be in a good relationship with this White House. And so, that's exactly what we're seeing. The lower boundary of this trading range has been just above the level where it's profitable for shale guys, and the upper boundary has been, at that point where it starts to heat up, and you see the tweets coming out saying, OPEC needs to get to work raising production. This is ridiculous. That's pretty much the two sides of this trading range. And I don't see any reason why it's going to leave that. And right now you've got a perfectly flat 50-day moving average. You've got 70 as basically the divining rod in that, and it's just sitting right there. So it's not particularly exciting to me right now, but at least I feel, relatively firm conviction on what sort of crude oil market I'm seeing right now.
All right, so all that not very compelling, and that's okay. We'll toss that one aside. I did get a listener question just a minute or so ago asking if you had officially moved your stopping gold yet.
It's a great question, and I have not, and I may well before the end of today. I mean, I don't even feel urgency about it. I might as well. I don't think it's going to see that stop. I guess I feel kind of like, but yeah, right. I mean, I probably would sell it if it broke under 1180. So I guess I've moved my mental stop, but not the stop that I have actually logged in on the market ladder.
Okay, so it's safe to say that if the listener is paying attention right now, you can go ahead and put your stop at that 1180 area?
Yes.
Okay.
I think I can firmly say yes to that.
Okay. All right. So there you have it. Okay. Any additional markets that you got a keen eye on that are compelling?
I mean, I'm still short long-term bonds, and that's been working again, even though I don't love it. It's one of those things. And I think, and this folds into the China situation as well, obviously, and maybe in some soft ways. I mean, you look for China responding or retaliating, and do they retaliate by, like I've heard, like the whole idea of skipping an auction, just to send a signal. I don't know whether or not that's the case, but I think that it's just interesting to reflect on the fact that the way that the global financial system works, particularly with dollars, is essentially Americans send money to China for stuff, and there's a reason for that. The reason why that happens is because the cost of living in China on a per capita basis is about I think if you just look at rent and groceries, it costs about 100% to 110% more to live in the United States on a per capita basis, and in a lot of places, much more. So the stuff in China is cheaper, not because China's trying to manipulate the situation, but because if you make like a widget that's somewhere upstream in a supply chain, so if you're a big company here and you want to sell these things and you need components, you can get them from a U.S. place, maybe you can get them from Guangdong where it's going to be way cheaper. And the reason it's way cheaper is because it costs a lot less to live in China. And that's just the whole problem that the White House is trying to address just comes from that fact. And you don't want to change that fact, or that's worse for our country. But if the way that what that results in is a system that is predicated on a very fundamental level in dollars going from the United States to China and stuff coming from China to the United States. And what that does is create demands for bonds because China takes those dollars and uses them to buy our debt. And we're using a model right now to run everything in this country that is just extraordinarily driven by deficits. We're just borrowing more and more and more money. So not only do we try to kind of maybe push China into a situation where they want to boycott buying our debt, but then also we're structuring our trade policy specifically to send fewer dollars over there for them to buy our debt. And it all creates a problem that is on the way in some form. And I don't know whether or not it's going to continue, but if the Jack Ma version of this, we just escalate further, and it keeps going on, it will come to a head at some point that is really bad. It's really bad for the United States in terms of how we fund and finance what we're doing and how we run our country. And from both sides of it, damaging the relationship with a creditor and sending less ammunition there with which to purchase and finance what we're doing. So that's the 30,000 foot view on what's happening in terms of the plumbing of global finance. That's a reality that can't be. It's not an opinion. It's just fact, and it's going to impinge itself on the way that we're dealing with things at some point, and I don't know when. But demand for treasuries is in there as part of that, and the question is, does that lead to a real problem? I think that at the end of the day, political solutions always trump financial conundrums, and always seems to be the case, even though people feel so much like there's this fixed law. Finance is not physics. It's a game that we play. And at the end of the day, at the bottom of that pyramid is politics. It's not finance. And we can make different rules for that game, and nobody, not even China, not anybody in the world, no matter how little respect they may have for the United States right now or how much or whatever, nobody wants to see a crash in the U.S. Treasury market. and that just breaks everything everywhere. And so that will be avoided in some level, but we're going to come to a point where we need to do things specifically to avoid that if we keep going in the direction that we're going. And some kind of pricing in of that risk is happening in the Treasury market on some level. Again, I don't think Treasuries are moving down right now because of inflation risk. I really don't. I think that it's other matters, and I think it has a little bit more to do with this stuff. And I think that if that sounds a little crazy, it really isn't crazy, especially with the direction deficits have gone, and having a trade policy now that's coming more and more into place around the concept that perfectly challenges that in a worse manner. So I think that it's tough to see sentiment where it is on bonds and continue to hold short bonds, but this flower hasn't bloomed, so I'm staying with that position.
All right.
If that makes sense.
Yeah. Well, it sounds like you're going to be pretty stable. Maybe add to gold. Be somewhat selective in equity holdings. Maybe take advantage of Tilray if that sets up for you. Buy some dips in the equity markets. Outside of that, though, it doesn't sound like you have a whole lot of activity that you're seing that's really all that compelling.
No, but granted, all of this is coming into context after the first week off that I've taken in a long time, and I've been back for a few days, but it still may be the case that I start to get a higher conviction, very strong feeling about something that we didn't talk about here within the next few days, just as I continue to watch what's going on, and possibly extension plays in equities. I'm not barring that. I may start to do that. It depends on how it sets up, particularly if we get some good, consolidation patterns that are lateral consolidation patterns with trigger levels. Even in the equity indices, we're just kind of grinding higher right now, which is a little tough to if you're trading futures on the long side in the equities market. It's tough in an environment where you're just kind of grinding up rather than kind of building ascending triangles and breaking out of them. Where you can define your risk, and right now you can just buy and hold it and see where it goes, and then decide if you don't like it to sell it. But I like particularly defined technical setups, and I haven't seen too many on the long side since I've been back, even though the market is moving higher. The one that I probably should be in is the Nikkei long, but that was the day after I came back, and I basically said to myself I wasn't going to jump in anything right then. So as I sit and watch things, I may be a lot more aggressive than it suggests in this conversation, simply because I'll have more tape back in my head.
Well, and not only that, you'll be pretty in depth on your chart book, so some things may occur to you on that as well. So,
and I've noticed, actually, it's funny that you mentioned that, because I've noticed a pattern that I tend to on the day of or the several days after publishing a chart book, I tend to trade more. And I wonder if it's because I go through the trade, the process of putting together a chart book is a process really a lot about searching for where my convictions are. And the research isn't just gathering information, it's just, waiting and absorbing information, but waiting for a sense of, oh, this is clicking, I understand this now. And when I do that, I put it in as a section in the chart book. And it takes me a few days to get there, because a lot of it is just sort of searching around like a person, in a dark room with a blindfold on, trying to figure out where the furniture is. And when I understand, oh, here's a chair, I put it in the chart book. And when I accumulate a number of those levels of conviction, it tends to lead to a greater sense of, seeing opportunities that are specific and defined. So that very well may be the case, that I get the chart book out and then suddenly I see a whole lot more. And we'll talk about that again. I mean, let's definitely talk again after the chart book is published and just kind of go over what I see.
Oh, well, there you have it. You gave us a cliffhanger.
All right.
All right. So next week we'll be on the lookout for chart book. Probably Monday or Tuesday he'll post that. You know what we didn't get today, though, Chart? I don't think I saw your morning update. Did you have any problems with that, or you just
I
lost
the text. Yeah, I lost the text, and I had spent so much time on the chart book that I didn't think that it was worth trying to put that up, and I knew we'd be talking.
All right. Well, hey, I'll bail you out. Got your back, Chart.
All right.
All right. Well, as always, thank you so much. Keep us posted. If you do anything in gold, if you make any adjustments to that position, add to it and whatnot. You already went verbally out there that you would move your stop. So listeners, take heed to that. And if you're do anything in Tilray, definitely, as you did yesterday, keep us posted.
Yeah. Well, and like I said, we've conceptually set our trap.
Yeah, and hopefully,
see if it walks into it.
Yeah, and if you need any help with that, or you need any additional commentary, feel free to ask him or ask us on the desk, and we'll be sure to help you out any way we can. As always, Brett, informative. Thank you so much.
Thank you, Jim.
All right.